We are now commencing the financial supplement section of our analysis. A financial supplement is a detailed set of data provided by a company to offer deeper insights beyond the standard financial statements, containing specific metrics that help investors grasp the full picture of business operations. Instead of just looking at headline revenue and operating profit, these supplements act like a microscope, allowing us to examine the intricate paths and operational efficiencies that lead to those results. For beginner investors, this is an opportunity to learn how to identify a company's actual profit structure, while intermediate investors should focus on how subtle changes in these metrics compared to the previous quarter might influence future stock prices. We will now meticulously analyze this data to uncover the underlying fundamental strength hidden behind the surface-level performance. Let's examine the key performance metrics that illustrate SoFi's growth trajectory. The most striking observation is the consistent expansion of the member base, projected to climb from 8.1 million in Q1 2024 to 14.7 million by Q1 2026, maintaining a robust year-over-year growth rate of approximately 35%. To clarify, YOY stands for year-over-year, comparing the current quarter to the same period last year, while QOQ stands for quarter-on-quarter, comparing it to the immediately preceding period. What is particularly noteworthy is that the total number of products is growing even faster than the membership, surpassing 22 million. This indicates a high cross-selling rate, meaning individual members are utilizing multiple services within the ecosystem. When we break this down, financial services products, which include checking, savings, and investments, are significantly outpacing lending products, or loan-related services. The projected 40.2% YOY growth in financial services by Q1 2026 confirms SoFi's successful transition into a comprehensive financial platform. This increasing product-to-member ratio is a powerful indicator of enhanced customer stickiness and long-term margin expansion. Looking at SoFi's segment financials, the most striking aspects are the robust growth in the lending segment and the explosive profit improvement in financial services. Starting with the lending segment, total originations are projected to rise sharply from approximately $4.3 billion in Q1 2024 to over $12.1 billion by Q1 2026. Originations refers to the total dollar amount of new loans processed and issued during a specific period, serving as a direct indicator of business activity. Personal and student loans are driving this growth, leading to a consistent upward trend in contribution profit. Contribution profit is a metric calculated by subtracting direct attributable expenses from revenue, showing the actual profitability of a specific business unit. While the technology platform segment remains stable, the most dramatic shift is seen in financial services. Its contribution profit is forecasted to surge more than fivefold, from $37 million in Q1 2024 to roughly $195 million in Q1 2026, suggesting SoFi's successful evolution into a comprehensive financial tech platform. Please note that non-GAAP figures are adjusted measures used to provide a clearer view of core operational performance by excluding certain accounting items. Ultimately, this data indicates that SoFi is successfully diversifying its revenue streams while maintaining strong growth across all major business segments. Looking at SoFi's segment financials, the most striking feature is the rapid growth and successful diversification of its revenue streams from 2022 to 2025. In the lending segment, personal loan originations are projected to surge from $9.7 billion to over $27.4 billion, acting as a primary growth engine. Loan origination refers to the total process of a lender providing a new loan to a borrower, essentially representing new business volume. While the technology platform maintains steady growth, the financial services segment shows the most dramatic turnaround. Its revenue is set to skyrocket from $167 million in 2022 to over $1.5 billion by 2025. Most importantly, this segment pivoted from a $199 million loss to a projected $792 million contribution profit. Contribution profit is the revenue remaining after subtracting direct variable expenses, indicating the inherent profitability of a specific business unit. This slide also uses non-GAAP figures, which are financial measures that exclude one-time items to provide a clearer view of a company's ongoing operational performance. In conclusion, these metrics demonstrate that SoFi is successfully evolving from a niche lender into a highly profitable, diversified fintech powerhouse. This slide provides a deep dive into SoFi's segment financials and projections through Q1 2026, which is crucial for assessing the quality of their growth. Looking at the lending segment, net interest income is projected to rise steadily from $266 million in Q1 2024 to $500 million by Q1 2026. Net interest income, or NII, is simply the difference between the interest earned on loans and the interest paid out to depositors. A standout trend is the explosive trajectory of the financial services segment. Its revenue is expected to nearly triple from $150 million to over $428 million, significantly boosting the contribution profit. Contribution profit represents revenue minus variable costs, showing how much a specific business unit actually adds to the bottom line before fixed overhead. Furthermore, the consolidated adjusted EBITDA is projected to grow from $144 million to $339 million. Adjusted EBITDA is a measure of core operational profitability that excludes non-cash items and one-time expenses. Overall, these figures suggest that SoFi is successfully diversifying its revenue streams beyond lending, evolving into a highly profitable comprehensive financial platform. Let's analyze SoFi's performance projections by business segment from 2022 to 2025. In the lending segment, net interest income is expected to rise sharply from $531 million in 2022 to $1.6 billion by 2025. Net interest income, or NII, is the core profit a bank makes from the difference between interest earned on loans and interest paid to depositors. A standout feature is the explosive growth in the financial services segment. Its contribution profit, which was a $199 million loss in 2022, is projected to flip to a profit in 2024 and reach $792 million by 2025. Contribution profit represents the profit each segment generates after covering its own direct variable costs. Looking at the consolidated figures, the shift to positive net income starting in 2024 marks a critical turning point in the company's fundamental strength. Furthermore, adjusted EBITDA is forecasted to exceed $1 billion by 2025. Adjusted EBITDA is a metric that shows a company's core operating performance by stripping out non-operating expenses like interest and taxes. These figures indicate that SoFi is successfully transitioning from a niche lender into a highly profitable, diversified financial technology powerhouse. Let's analyze the components and future outlook of net interest margin, or NIM, which is the key driver of SoFi's profitability. To clarify, net interest margin, NIM, is a core profitability metric representing the difference between interest income generated from loans and interest paid out on deposits, relative to total assets. Looking at the average balances at the top, total interest-earning assets are projected to grow sharply from approximately $27.4 billion in Q1 2024 to $47.3 billion by Q1 2026. This indicates an aggressive expansion of SoFi's business scale. A notable trend is the simultaneous decline in both asset yields and liability costs. While the yield on assets is expected to decrease from 9.76% to 8.58%, the cost of interest-bearing liabilities is projected to drop even more significantly, from 4.40% to 3.10%. Consequently, the net interest margin at the bottom remains stable, fluctuating between the high 5% and low 6% range. This data demonstrates SoFi's robust fundamentals and its ability to maintain high profitability through efficient funding, even in a potential declining interest rate environment. This slide analyzes the fair value of SoFi's loan portfolio, a key metric for assessing asset growth and valuation. Fair value represents the estimated price at which an asset could be sold in the current market, while cumulative FV adjustments are changes made to the asset's value to account for fluctuations in interest rates or credit risks. Looking at the overall trend, the total fair value of loans is projected to nearly double, rising from $21.9 billion in Q1 2024 to $40.6 billion by Q1 2026. While personal loans provide a steady foundation, the exponential growth in student and home loans indicates a successful diversification of their credit mix. In particular, the home loan segment is expected to see a massive increase compared to early 2024, emerging as a powerful growth engine. This rapid expansion of assets suggests that SoFi is evolving into a comprehensive financial powerhouse, signaling strong potential for significant interest income growth in the near future. The 90-plus day delinquency data serves as a critical barometer for evaluating a financial institution's asset quality. In the personal loans segment, although the total unpaid principal surged from approximately $14.3 billion in Q1 2024 to $22.3 billion by Q1 2026, the delinquency rate actually improved, dropping from 0.72% to 0.47%. To explain, 90-day delinquency refers to a loan where payments are overdue by more than 3 months, signaling a high risk that the debt may not be recovered. The student loans category maintains an exceptionally low delinquency rate in the 0.1% range, which indicates a highly creditworthy borrower base. Furthermore, the fair value of loans, defined as the estimated current market price of the loan assets if they were traded today, is being managed effectively alongside the growth in volume. Overall, these metrics demonstrate that the company is successfully maintaining strict risk discipline even during a period of rapid portfolio expansion. Let's examine the key indicators from SoFi's balance sheet as of the first quarter of 2026. Total assets stand at approximately $53.7 billion, with the largest portion being the loan portfolio valued at $42.1 billion. Fair value refers to the current price at which an asset can be bought or sold in the market. Here, personal loans of $23.7 billion and student loans of $15.3 billion are recorded at this value to reflect their real-time worth. On the liability side, the most striking figure is the $40.2 billion in deposits. This indicates that the company has successfully transitioned into a stable banking model that funds its lending operations through customer deposits rather than relying heavily on external borrowing. Among the liabilities, convertible senior notes are debt instruments that can later be converted into shares of stock, currently totaling about $1.3 billion. Consequently, with a robust equity position of $10.8 billion, the company is effectively balancing asset growth with financial stability. This quarter's data demonstrates that SoFi is further solidifying its position as a major financial institution with significant deposit-taking capabilities, moving beyond its roots as a fintech startup. Let's examine the key metrics illustrating SoFi's financial reconciliation and growth outlook. The most striking takeaway is the steep upward trajectory of adjusted net revenue. Projected to rise from approximately $580 million in Q1 2024 to over $1.08 billion by Q1 2026, this represents nearly a twofold increase in just 2 years. To clarify, non-GAAP refers to adjusted financial measures that exclude one-time items or accounting anomalies to reveal a company's core underlying performance. Looking at the breakdown, while the lending sector remains a solid foundation, the financial services segment is a primary growth engine, surging from $150 million to over $420 million. The trend in adjusted EBITDA at the bottom is equally promising. Adjusted EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It effectively measures a company's actual cash-generating power from its operations. The expansion of this figure from $144 million to roughly $340 million signals that the company is achieving both top-line growth and significant margin expansion. Ultimately, This data indicates that SoFi has surpassed the initial fintech phase and entered a period of powerful, disciplined profit growth through economies of scale. Let's analyze the non-GAAP financial reconciliation, which clearly illustrates SoFi's actual performance. Non-GAAP refers to figures adjusted from the standard GAAP accounting to exclude one-time costs or non-cash expenses, providing a clearer view of core business operations. Looking at the adjusted net revenue, we see a steep upward trend from approximately $1.5 billion in 2022 to a projected $3.59 billion by 2025. A key highlight is the shift in revenue mix across business segments. While the lending segment remains solid, the financial services segment is driving explosive growth, surging over ninefold from $167 million in 2022 to $1.5 billion in 2025. The adjusted EBITDA, which reflects a company's cash-generating power, also shows a dramatic trajectory. Adjusted EBITDA is a metric that evaluates actual cash flow from operations by taking earnings before interest, taxes, depreciation, and amortization and making specific adjustments. This figure is projected to jump from $143 million in 2022 to over $1 billion by 2025, suggesting that the profit model has reached a significant scale. Ultimately, the data indicates that SoFi is successfully achieving both top-line growth and bottom-line profitability, which will likely strengthen market confidence. Let's examine the non-GAAP reconciliation table, which provides a clear view of SoFi's underlying performance. Non-GAAP refers to adjusted figures that exclude one-time accounting items to reflect a company's core operational strength. Looking at the trend in adjusted net revenue, it shows robust growth, climbing from $580 million in Q1 2024 to $1.08 billion by Q1 2026. A key highlight here is the adjusted EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it serves as a measure of a company's ability to generate cash from its operations. Adjusted EBITDA more than doubled from $144 million in Q1 2024 to $339 million in Q1 2026, with the margin expanding from 25% to 31% over the same period. While the GAAP net income spiked to $332 million in Q4 2024, this was largely due to a one-time $272 million income tax benefit. The consistent improvement in adjusted metrics is the true indicator of value. This trajectory of margin expansion suggests that SoFi's business model is scaling efficiently, which will likely be viewed as a strong positive signal by the market. Let's examine SoFi's actual profitability through the non-GAAP reconciliation metrics. GAAP refers to the standard accounting rules all public companies must follow, while non-GAAP represents adjusted figures that exclude one-time or non-cash items to provide a clearer view of core business performance. The most striking trend in this data is the massive shift from net losses through 2023 to a projected net income of $498 million in 2024. Of particular note is the rapid growth in adjusted EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it serves as a key indicator of a company's raw cash-generating power from its operations. Adjusted EBITDA is forecasted to surge from $143 million in 2022 to over $1.05 billion by 2025. Furthermore, the adjusted EBITDA margin is expected to expand more than threefold, from 9% in 2022 to 29% by 2025. This expansion demonstrates powerful operating leverage, where profits grow significantly faster than revenue. Overall, these figures suggest that SoFi has successfully transitioned from a growth-focused startup into a highly profitable and stable financial platform. This slide details the reconciliation of non-GAAP financial measures, which is essential for identifying SoFi's true business performance beyond standard accounting rules. Looking at the adjusted net revenue for the lending segment, we see a powerful growth trajectory. nearly doubling from $325 million in early 2024 to a projected $629 million by the first quarter of 2026. For context, non-GAAP measures refer to financial indicators that exclude one-time or non-cash items to provide a clearer view of core operations, while FMV, or fair market value, represents the estimated current market price of an asset. By stripping away volatile FMV fluctuations, this data reveals the underlying strength and scalability of their lending business. Furthermore, total adjusted non-interest income is expected to reach $394 million by Q1 2026, signaling a successful diversification of revenue streams. This consistent upward trend across all adjusted metrics provides a strong foundation for the belief that SoFi is effectively scaling its operations while maintaining high-quality earnings growth. This slide analyzes how SoFi's GAAP net income is reconciled to reflect the underlying business fundamentals. GAAP refers to the standard accounting rules all public companies must follow, while non-GAAP represents adjusted figures that exclude one-time costs or gains to show a company's core performance. Looking at the Q4 2024 metrics, GAAP net income spikes to approximately $332 million, primarily due to a one-time tax benefit of $258 million. Therefore, rather than assuming an explosive earnings jump, investors should focus on the adjusted net income of $61 million to gauge sustainable profitability. The revenue trend shows adjusted net revenue growing from $580 million in Q1 2024 to over $1 billion by Q1 2026, indicating consistent and robust growth. Notably, the adjusted net income margin is projected to rise to 17% by late 2025, proving that the profit structure is becoming more efficient through economies of scale. This steady improvement in profitability provides a strong basis for the market to positively value SoFi's future growth potential. This slide provides a detailed reconciliation between SoFi's GAAP net income and its non-GAAP financial measures. To clarify, GAAP refers to the standard accounting rules companies must follow, while non-GAAP adjustments remove one-time or non-cash items to reveal the underlying health of the core business. Looking at the trend, the most significant takeaway is the dramatic swing from net losses in 2022 and 2023 to a projected breakout into profitability starting in 2024. In 2024, the GAAP net income appears higher than the adjusted figure due to a one-time tax valuation allowance benefit of approximately $258 million. However, even excluding these accounting anomalies, the adjusted net income is expected to surge to $481 million by 2025. The expansion of the adjusted net income margin from negative 21% in 2022 to a positive 13% by 2025 demonstrates that SoFi is successfully achieving economies of scale and sustainable long-term growth. Let's examine SoFi's adjusted net income and EPS trends, which reveal the company's true fundamental health. A striking point in this table is Q4 2024. While GAAP net income surged to $332 million, this was primarily due to a one-time tax valuation allowance benefit of $258 million rather than core operational growth. GAAP refers to standard accounting rules, whereas non-GAAP adjustments remove these one-time items to show the real recurring performance of the business. Looking at the adjusted net income trend, it shows a steep upward trajectory from $22.5 million in Q1 2024 to a projected $167 million by Q1 2026. Notably, diluted EPS is forecasted to grow from 2 cents to 12 cents during this period. Diluted EPS is a conservative measure that assumes all convertible securities are turned into stock, providing the most accurate profit per share view for investors. This consistent growth in adjusted profitability indicates that SoFi is achieving significant operating leverage, which is a very positive signal for long-term market confidence. This slide details the reconciliation of SoFi's non-GAAP financial measures, which is crucial for understanding the company's underlying profitability. Non-GAAP refers to financial metrics that exclude one-time or non-cash items to provide a clearer view of a company's core business performance beyond standard accounting rules. Looking at the trend, the net loss recorded through 2023 swings dramatically to a profit of over $434 million starting in 2024. A key adjustment includes the $247 million goodwill impairment in 2023. This is a non-cash charge taken when the value of an acquired asset drops below its purchase price, which, when excluded, reveals a much stronger fundamental growth trajectory. Adjusted earnings per share, EPS, is also projected to climb from a 10-cent loss in 2023 to a 39-cent profit by 2025. This transition indicates that SoFi has successfully shifted from a high-growth startup phase into a profitable enterprise with a sustainable and scalable business model. Let's examine the key financial metrics that reveal SoFi's true business performance and fundamental strength. First, focus on the trend of adjusted net income. GAAP refers to standard accounting principles, while non-GAAP measures exclude one-time or non-cash items to highlight the core profitability of the business. While the 2024 GAAP net income spiked to $434 million included one-time tax benefits, the adjusted net income of $163 million confirms a sustainable turnaround into profitability. Notably, the 2025 projections show a steady quarterly climb, aiming for an annual total of over $482 million. Moving to tangible book value, which represents the firm's intrinsic value, we see it nearly doubling from $3.2 billion in 2022 to a projected $6 billion by 2025. Tangible book value measures the net asset value of a company after excluding intangible assets like brand value or goodwill. The most critical indicator, return on tangible common equity, ROTCE, is projected to soar from negative 11.1% in 2022 to 8% in 2025. This rapid improvement signifies that SoFi has reached a stage of high capital efficiency, providing a strong signal to the market that it is successfully transitioning from a growth startup into a consistently profitable financial institution. Let's examine the financial reconciliation table showing SoFi's intrinsic value growth from 2024 to 2026. The most striking trend is the GAAP total permanent equity, which is projected to nearly double from $5.8 billion to $10.8 billion. To clarify, GAAP stands for Generally Accepted Accounting Principles, a set of standard rules that ensure financial reports are transparent and comparable across companies. A key metric to focus on here is the tangible book value, which represents the net value of physical assets after excluding intangible items like goodwill or brand value. This value is expected to surge from $4.1 billion in Q1 2024 to over $9.2 billion by Q1 2026. What's particularly impressive is that the tangible book value per share is rising from $3.90 to $7.21, even as the number of outstanding shares increases. This upward trajectory indicates that SoFi is not just expanding its scale but is effectively compounding its intrinsic value per share. This data sends a strong signal to the market that the company is building a solid financial foundation for long-term shareholder returns. This slide details the reconciliation between SoFi's GAAP net revenue and its non-GAAP cash revenue. While GAAP refers to generally accepted accounting principles, the standard rules for financial reporting, investors often look at non-GAAP figures to understand a company's actual cash-generating power, stripping away non-cash accounting items. Looking at the total net revenue, GAAP, at the top, we see a powerful upward trajectory from $984 million in 2021 to a projected $3.6 billion by 2025. However, the most compelling data point is the cash revenue line at the bottom. The jump from $2.65 billion in 2024 to an estimated $3.75 billion in 2025 represents a massive 41% growth, indicating that the business is becoming increasingly efficient at converting operations into liquid cash. A key driver here is securitization, which is the process of pooling loan assets into interest-bearing securities to sell to investors for immediate cash. The adjustment for loan originations and securitizations shifts from a significant deduction in earlier years to a $215 million addition by 2025. This transition signals a fundamental maturation of SoFi's lending model, moving toward a self-sustaining, cash-positive cycle. With Q1 2026 cash revenue projected to surpass $1 billion, the data confirms that SoFi is successfully scaling its revenue quality alongside its top-line growth.